Hello, I'm Shaun Richards and Not a Yes Man's Economics. What I want to talk about today is interest rate cuts, and there's also a subplot to this, which is how central banks think they'll respond to the coronavirus and the problems that have started so far in 2020. Now, yesterday we saw at the Bank of England a sort of almost an episode of the children's TV series Stingray, which, if you recall, if you ever watched it, starts with the phrase "stand by for action." Why? Well, it cut interest rates to equal the lowest level ever in the UK, so a 0.5% cut, to 0.25%. Now that's kind of a generic going on, and I expect most central banks around the world to follow that pattern. United States has already gone once, may go again. Europe and the Bank of Japan will be more constrained because they already have negative interest rates. But that's the headline. The more important stuff is in the detail. What the UK has had before, and has been revived this morning, is something called the Term Funding Scheme. Now what this is a type of credit easing. And as the credit crunch era has gone on, central banks have moved away from things like interest rate cuts, although they've had another go at it today. Why? Because they're running out of ammunition there. They've done lots of bond purchases like QE. Right? There's a hint there they're not doing a lot more of that right now. They're not convinced that works anymore. So they've moved on to credit easing. So let me explain how this works. If a bank comes to a situation where it wants to lend, in theory now, it can go to the Bank of England and essentially get the money. So the new bank rate will be 0.25%, and the Term Funding Scheme will allow banks to go to it and say, well, look what we've done. Can we have some money at 0.25% or very close to it? So that's the theory. The next step in the theory is that in this situation, they'll then go out and lend that to businesses. Now, we've seen some real hype about this morning. The implication that it will be 100 billion. There's another number thrown around by the new Bank of England governor, Andrew Bailey, or at least he'll be the new one next week, of 190 billion. So as you can see, there's some numbers bingo here, but there's a catch. You see, we've seen this before, and the reality is not that money goes into small business lending, but in fact, it goes into unsecured credit and also mortgage lending. There was a similar programme in the UK called the Funding for Lending Scheme that started in 2012, and if we take subsequent schemes forward, took net mortgage lending in the UK from negative to these days round about plus 4 billion. So as you can see, there was a big gain there. And the banks took the extra liquidity at cheap rates to offer lower mortgage rates. So good for those actually in the housing market, not so good for those looking to buy, because they might find or feel, that they can, get in and buy something, but the trouble is prices then tend to move away. The next leg of this situation in the UK was that unsecured lending, consumer credit, however you want to put it, surged. So credit card borrowing, overdrafts, other advances, that sort of thing, went through the roof. Growth peaked at around about 11% a year, and this carried on for a couple of years. So this is the pattern that I expect now. We'll see similar schemes announced by other central banks, but if the pattern holds, and one of the lessons of the credit crunch era is that these patterns do hold, they'll tell people that this is to boost business spending. There'll be cheers from the media saying, well done. Then in a year or two's time, people will be looking at it and saying, how come mortgage lending's done so well? How come house prices have done so well? How come there's been more consumer credit? And that's the reality in the modern era. Thank you.